Hello, good evening all. Welcome to this episode of Almas. I am Jayaram Krishnamurthy, one of the co-founders of Almas. As most of you might be aware, Almas is in the business of managing currency, commodity, and interest rate risks for corporates. And apart from our normal risk management activities, we also have this forum where the intention is to share knowledge on important segments of market and economy that is relevant to the businesses. And what we look to do here is to share in a simple way the ABCD of the subject matter in an uncomplicated way for the participants. And in today's session, we will be talking about one of the most important asset class, gold, as to its short, medium, and long-term trend. And to speak about the same, we have two eminent persons on the forum. Mr. Yeshwant Rao, one of the panelists, is an independent consultant on currencies and commodities price risk management. He was formerly head of strategies, commodity price risk management with Reliance Industries Limited, head of forex risk management with Arvind Limited, forex consultant to corporates with Patterson and Company, FX broker. At Arvind, he was managing cotton risks in 2 years between 2013 and 14 after retiring from Reliance. He is currently a member of the Product Advisory Committee at the National Stock Exchange. Now, we are also happy to have Mr. Jaydeep Banerjee, who is a co-founder of Dwara Smart Gold, a fintech organization working towards gold-based financial inclusion for women of low-income households. Jaydeep has been a transformation professional with 30 years plus hands-on experience working for leading companies, including Fortune 500. The Inchcape Group, globally renowned jeweler Tiffany and Company, and major luxury retailers in India and overseas. With deep consumer insights, he understands the nuances of trade in different cultures. Jaydeep comes with a heavy transactions background, including startup operations and planning. He carries extensive experience with companies in retail, insurance, and manufacturing sector. Sirs, I welcome you both with pleasure to participate and share your expert knowledge on the subject. Now, before I move on to hand over the speakers, I'll just touch upon a few basic facts.
Thank you, Jayaramji.
Yes, sir. Before we move on to the speakers and hand you over to share their thoughts, I will just touch upon a few basic facts on gold. Gold is undoubtedly one of the most popular assets on the planet, I would say, held by everyone, right from central banks worldwide to individuals across. And of course, the four key reasons the investors hold gold is in their portfolio is the returns, diversification, liquidity, and safety. Just to highlight a few points on gold, I would like to share a few slides. So when we talk of the medium to long-term view, whose perspective? It's investors, consumers, and the central banks. Now, these are the important players in the gold market. Now, if you look at it from the investor's point of view, the performance of gold is no less than, in fact, better than stock market. If you consider a long period of 50 years, we had 15.1% return on gold and the real return at 8.3% in a high inflation scenario. And in a low inflation scenario, it was not bad at 5.6% and 3.6% real return. Compare it with the stock market that gave you 10.53%. And inflation adjusted, it was 6.327%. So gold as an asset class is actually doing over the period very well compared to the stock market, where there's you have much more participation as well. Now, if you look at from the consumption point of view, India and China were the largest gold consuming countries in 2010, and both of them have maintained this status in 2022 with a consumption of 824.9 and 774 metric tons respectively. But if you look at the latest trend, the gold consumption in India has actually dropped. The Q1 of 2023, on a year-on-year basis, consumption has dropped by 17%. And on a QOQ basis, that is comparing with the Q4 of 22 with Q1 of 23, we have a 65% drop in the consumption, India's gold consumption, whereas China has still continued to maintain, the leadership in consumption of gold. Now, coming finally to the central bank's actions, right from January 2022, we have seen a steady increase in gold purchases by the central bank, and that has resulted in a huge support for gold prices. Whenever we see a panic sell-off in the gold, or touching very important levels, central banks have come and acquired a lot of gold. And in this respect, India, Russia, China, and Kazakhstan have really been major players in purchase of gold as far as central, because gold, as you all know, happens to be one of the reserve assets for the central banks as well. Now, with that, I stop my introduction and I hand over to Mr. Rao. Sir, I want to start with you, by asking you this question. Now, for long, gold is being talked about as headed into new highs. We have heard targets of 2,500 and beyond. But what we actually have seen is prices failing about 2,000 three times and falling sharply. What should we be looking for in the coming months about gold? What targets are reasonable, and what will be driving it? I would like to hear an expert and experienced view on gold from the hedgers and the investor point of view. Over to Mr. Rao. Thank you.
Mr. Rao, you're on mute.
I think it's okay now.
Yes, sir. Yes.
Okay. I have to talk a few things before giving my view on this. The convention is like conventional wisdom states that it has a correlation with the dollar index, treasury yields, inflation, central banks policies, geopolitical economic uncertainties, besides seasonality. I'll quickly go through this. Most of these are myths. For instance, this is the correlation chart. This is a perfect correlation. This is between euro and dollar index. You see it's a perfect 90 minus 90 inverse correlation. It is mirroring exactly. But if you go to see, it is totally a data driven exercise. If you see correlation between gold and dollar index, you see here, this is what we all think, that it is inversely correlated. If DXY rises, gold will fall, and DXY fall, gold will rise, inverse. But it is not so. You can see I have taken data from 2009. The perfect correlation should be below 80. It is many times it fails to go 80. It even goes to the positive side. So this is not exactly a measure to guess gold's price. Next is correlation between gold and US 10-year treasuries. Same story. It's not a perfectly correlated item, which I showed in the beginning between euro and dollar index. Then comes inflation. The rising inflation, I put both inflation. Blue line is US inflation, orange line is Euro inflation, and the purple one is gold. Rising inflation but falling gold price is not as per conventional wisdom. Wherever I have put an orange ellipse, inflation has been steadily rising, gold has chosen to fall. If you go back in the history, you will find many such instances where even inflation is not a proper measure. Then I chose, are you able to see this? This is, or is the print too small? See, now I have made it bigger. I have taken out from the history important instances, QE, when it started. Generally, it should rise. So it has risen, correct? I agree. Here, it must rise. QE2, there also. QE3, it took a reverse gear. It started coming down. Then QE tapering. See, this should have also driven the price up. Instead, it brought it down. And then QE tapering. This showed a negative bias as expected. That is correct. A negative bias is not in the sense like it plummeted. It was on a lower gradient. Then we have Q4 start, QE4. This is pandemic, post-pandemic helicopter money that That has driven. It is as per expected. Then Fed rate hike started. This is the Russian invasion. Not very clear. Actually, it should have driven the prices higher as a safe haven. Then Fed rate hike started in March 22 and still continuing till now. It fell for some time and rose for some time. Not very clear. So this also cannot be relied upon totally. What I mean to say is there are so many aspects which can help you in deciding gold's future. For instance, now we anticipate the price of the US Fed is going to stop raising the interest rate by the year end. They may have one or two in their quiver, then they are going to stop this. That should drive the price of gold up. A lower interest, a higher gold. A lower interest, lower dollar, higher gold. That is an anticipation based on this. And coming to seasonality, this is only I have done XAU. You see, as per this study based on closing prices for the last 25 years, most bullish month is October. 64% of the time it is taken on the basis of bullish close per month, like that. So followed by Feb, June, and July. And bearish months, April, followed by December, and then September. So this also can be, I have checked the data. To some extent, these are correct. That is per month. You can guess the prices per month based on this. This also agrees with the Chinese New Year, Indian festive season, Indian wedding season. All these things, it correlates well with that. This is the same point. Now I will come to something which I use. See, I have been using, there are two aspects, technical analysis and Elliott wave theory. Technical analysis will not help you to guess the direction and the trend and the targets, all these things. It may not be able to guess properly. This is if you want to know about Elliott wave, you Google Elliott wave analysis. You will get 4 crore 78 lakh sites talking about this. 4 crore 78 lakhs. So many people in the financial world. It has been proven mathematically by Benoit Manboard of IBM that market structure is based on Elliott wave only. So I use this for my prediction, not exactly prediction, the projection, future projection. This is the only method which is available. All the other technical tools will help you guess what is the current trend and what is the current momentum. That's all. It will not tell you about the target, where it may take a U-turn. Those things will not be possible in other technical analysis. Like the fundamental analysis, just now I have shown you that so many myths are there about whatever I have spoken about, dollar index, treasury bills and all. Now I will go quickly through a chart. This is the XAU chart. This is the monthly chart. This is not a weekly or quarterly chart. So each bar represents a month. As per Elliott wave, it has started a blue line. It shows, you can see a circle, first wave and second wave. If some of you follow this Elliott wave, the third wave is over, fourth wave is over. Now we are on the fifth wave, which is the last part of this. This has a projection, target projection at 2,285. That is the target, upside target for this. And we want to know whether it will be reached before this year. There you have to see this. I made some analysis here. I have given nearest objective 2000. Rise above 1990 would be encouraging. But what looks more probable is that it has done a mean reversion. There is going to be a second trip, downward trip now, which will stall near 1850 or 1750 to resume the uptrend. So when do you expect this dip? 1850, 1750 for the rest of the period, as long as we stay below 1900. Rest of 2023 will be seeing up down move touching 1850 or 1750 before making a U-turn to start the rally. The confidence I'm telling this confidently. The confidence of this view would be shaken if price unexpectedly follows below 1590. That's a bit far off, but that's how, when you talk about monthly chart, long-term picture, your stops will be. If you say that confidence will be shaken, then what action should be taken? I don't know. We have to improvise at that time. We go according to a map. If something goes wrong, then we think about that. It beforehand itself, we will get to know that this view is evolving as per expectation. Now it's going to evolve future move also as per expectation. If something goes wrong, we'll start getting hints beforehand, 1 month before, 1 week before, 3 days before, we'll start getting. We have to take action accordingly. This is for XAU. Now I'll go for MCX. This I don't have much of a confidence in this view because it is linked to rupee, not plain metal like XAU. It is linked to rupee strength, rupee's weakness also. I have given a view. Initially, it has scope to dip. Supports 57,000, 55,400. Risky below 54,650. It should not dip below there. Just like XAU, this also will dip a little and then it will start rising towards 63,400, 64,900. If it directly crosses above 60-70, that would be a bullish sign. Then that will kind of reduce the chances of the expected dip. I have mentioned 2 levels. It will dip there and then start rising. Here also, the dip is expected to happen during the rest of 2023. Complete the dip. There itself, it will start. It will make a U-turn in that area and then start rising. The target which I have mentioned is a projected one. It might change a little after we approach that. So we keep adjusting the targets. We keep adjusting the support as we move forward. As of now, for this meeting purpose, I have arrived at this. For short and medium term, we can be sent by Almas if you have concluded arrangements with them. Medium and long-term views have been discussed just now. With this, I end my presentation.
Sir, on this, do you have any timeline for reaching those targets in the XAU or in the rupee gold targets?
Yeah. I will just explain that with a real chart. This is MCX. See, you can, I will delete this line. You can see here also, it is like 1, 2, 3. This is the 4th wave, 5th wave has started. You can see thin brown line. This is where it is going to be. I'm going to find a thing. Entire. The line bifurcating this, which meets the target, you just see it happens around September 23.
Okay.
So that is the first nearest date to anticipate a rally to that. If it as we move forward in this time, my expectation is it will spend some time. It may come here and then reach the target. As we come to this place, January 2024, then the target goes to, you just see in this area, the time will appear. This is a rising gradient. You see here, the target is 66,700 around January 24. As we move in time, as long as the price holds above the support line, the target gets extended to the higher side. That is the view on this. So the answer to your question is, the upside, the earliest possibility is September, October 2024. The latest possibility you can say somewhere in the first or second quarter of 2024. That is the maximum time. I anticipate, see, this is a what do you call it? An impulsive move. This one is an impulsive move. It will correct A, B, C, or it will do some confused manner like that. Then it will break out and start rising. That period I'm aiming at, that may be September also, or most probably it may be in the first quarter of 2024. Anything?
Got it, sir.
Okay.
Thank you, sir.
Okay.
So I now want to ask you, Jaydeep, you've been part of the movement to help small investors to invest in gold. And given the varied conditions and volatility, what would be your advice to them on the ways to invest? Should it be SIP based or a ETF based or even physical gold buying? Or even we have something called RBI gold bonds. So considering the risk appetite that small investors will probably have, what ways do you suggest and what should be their approach, sir?
See, first of all, I am not an economist like Mr. Rao is, and Mr. Rao, thank you so much for that enlightening this thing. It as a consumer and as a business owner, it is an eye opener. It's wonderful. While you're talking, I was also trying to figure out the Elliott wave analysis myself. But thank you so much for it's very enlightening. See, now coming to the consumer part of it, I have spent close to 30 years, like you mentioned, in this consumer space. I call gold, actually, no, let me say digital gold. I call it in the economic terms as a FAAA rating to me. I know there is BAAA, and I always call digital gold as an FAAA for me, simply because there are a lot of advantages. And this is where my customer comes in. Why do I call it FAAA? Because it's fungible, it is affordable, it is accessible, and it is available. Now let us come to my kind of customer base, what we deal in. Since I'm not an economist, I can at the most say that I'm like a transformist. I am trying to transform the customer behavior here. Mr. Rao has said that gold as an asset class is difficult to predict in terms of prices because there are a lot of myths associated with it. Dollar index, economic downturn, US Fed rates freezing. There are various aspects. However, gold follows its own pattern. The reason gold follows its own pattern is simply because the consumers love gold, not from the Egyptian pharaoh's time. They have used it as an adornment. They have emotional appeal. It's a social status. Which means, and you look how the seasonality of gold improves during the festival season, during the marriage season. So it is, while I don't have empirical evidence, to some extent it looks like that gold follows the consumer's way of rising prices. It is not so much industrial as much as consumers, because the demand goes up at that point in time when there are. Now coming to the customer base we are attaching. In a country like India today, there is no social security at the rural level. There are nothing that these people can actually fall back on in terms of an emergency. What happens is, traditionally, gold has been consumed almost 95% of the jewelry trade in this country is gold. It is consumed through the traditional route of going to a retail store. Now, these retail stores are again available in A towns, B towns, maybe satellite towns closer to large towns, which means for the consumer base of a rural customer who could be an agricultural worker, farm worker, could be a contract laborer, could be working in 100-day wages, maybe Moderator. These customers use that day's wages to go and deposit certain money with a jeweler. That is how they consume gold regularly. They go to a jeweler, they deposit some money, then they go month on month into increase the deposit. And on the 11th or 12th month, the jeweler puts in some more money, and they get a piece of gold jewelry. Let us look at this journey compared to a digital journey. If this is the traditional way consumer has been taking gold, there are a couple of things that are happening here. One is that the jeweler is taking the money but not backing it physical gold, which means consumer does not have the benefit of the rate of that particular day. Number one. If the consumer goes back and asks that, can I take the portion of this back today because I'm in emergency? He will say, no, not possible. You please come back in the 12th month and take it in form of a jewelry. Because his entire business model is based on the making charges that he will make at the end of the tenure. So a consumer who is going the traditional route to buy jewelry is actually landing up paying a bare minimum of 12 to 15%, sometime higher. Even if it is pure, even if it is gold coins and bars, he's paying higher of 2 to 5% of making charges, which means a portion of what he's able to consume is actually in terms of making charges. When he does not want the design, it becomes obsolete. He goes back to the same jeweler who then melts the gold and again charges him melting charges and further again charges making charges for another piece of jewelry. What happens to this customer base is that the value of their investment keeps depleting because of the making charges and the conversion charges, retail margins that keep getting added. And if the customer needs money in emergency, it is not possible. So what happens in digital gold is these people today can consume at their own homes. So there is no loss of pay for that. There's no loss of energy or pay for that particular day. They can consume in the denomination that they want to consume in. They can consume 100 rupees, 500 rupees, 1000 rupees. They can decide. They can decide when they want to consume it instead of being fixed on you have to come month on month and deposit it. Most importantly, they can take this money at any given point in time. Whether you look at, I will come to sovereign gold bonds, ETF and all of them. First of all, for this consumer base, that is not even possible because they need a demat account.
Yes.
To even do that. Number one, digital gold. Why did I call it FAAA? First of all, it is affordable because you can consume it at maybe 100 rupees even. It is left to you. Second, it is accessible. It is accessible 24/7. If it is anything is exchange traded, whether it is ETF or sovereign gold bonds, you have to depend on the stock market, which is again maybe up to 3:30. Also not working on the weekend, so their gold is not available. The entry and exit barrier is not easy. There is an 8-year lock-in. You can, after 5 years, you can come out of it. Then there is no other charge in digital gold except GST. If for ETFs you have to pay year on year, you have to also pay the charges. So when you look at all of this, it is an affordable, accessible, continuously available at any given point in time, and fully fungible. You can also convert this back into jewelry. You can convert this into maybe bank transfer. Most importantly, you can also take a loan against it. So what happens with this consumer base is why we created this business was so that this consumer base can slowly and steadily partake in the main financial markets of the country, in sitting from the rural areas where with hitherto they have no access to the markets simply because they have no information, they have no education, and they do not understand how the financial markets operate. You actually compare this, contrast this with gold, they understand everything about the asset class. So hence gold has remained popular amongst this asset class. And we continue to see this. We have built this business only, we created this company only 3-4 years. But I see today, almost 70% of my customers today, and it's a large customer base today, is continuously persisting with their monthly installments, whether there is a downturn, whether there is a pandemic, whether they're able to pay loans, whether they pay to health insurance, but they continue to invest in gold because they see a longer game in this. Because if they do this, there is no other hidden charges. It is always available to them, available in terms of emergency. If at one point in time they don't want to pay, it's like their own savings account. So you look at the overall thing, we believe that, the current import bill of the country, which was in 2021 was almost at 46 billion. Now it's come down last year. It has come down to 35 from 46. I believe somewhere digital gold has played a part in bringing the import bill of the country down. So it is a revolution waiting to happen in the country because more and more people will actually come out. More and more people will invest in digital gold. This is going to be the maybe the the Paytm moment for demonetization. It is heading in that direction over a period of time, because slowly and steadily and with a younger customer base, they are also understanding, and all the customer base today are app savvy. They want something which is an app. Even the food comes on the app, their clothes and their accessories, apparels, their social media, everything is app based today. For this consumer base, and this is slowly catching up after the geo revolution, it is slowly catching up even in rural villages. If they get an access to this, access to a convenient, flexible, affordable way of investing in gold, the asset class itself builds a much larger market. So it is very unpredictable. Mr. Rao has already conveyed that it is very unpredictable, the price of gold, but I don't see whether the price goes north or south. I don't see the demand going down at all, because the fundamentals of wanting that gold asset remains the same. The fundamental is I want to own it, I want to flaunt it. It is my adornment, it is an emotional appeal. Secondly, 95% of our customer base today are women. So we look at this as, and it is in the women in the village. So we look at this as a direct correlation with empowerment. I'll give you an example, because I have got enough and more customer testimonials to show that. The father or the father-in-law in a village owns the land or the business. The brother or the brother-in-law is running the business. The daughter or the daughter-in-law, the house is only holding on to few gold coins or maybe gold saving, and that is her contribution to the society, to her family. For her social standing, the fact today women that we have 95% of them, I tell you, are women, customers. Today, all of them are talking about how they can educate their children, how they can buy a livestock, how they are able to manage the household expenses. When I ask a woman, what does your husband do? He said he's a fitter or a plumber or something. So I say, how do you manage? She's saying, I have my gold and I look after the financial part of it because I can invest in gold in this form. So I see this as a transformation opportunity in this country. And I think it is a revolution waiting to happen very quickly. And like Mr. Rao has already said, we cannot predict the prices on because of various other indices, and whether it is the whether it is the economic downturn or the dollar index or maybe an index basket of currency index, whatever we do today, because the demand is steady and the demand will continue to rise.
That was very enlightening, Jaydeep. Really, I think that is one market where most of us don't know the nuances, and really you have given us the deep insight into that market. But as I understand, this is the opposite of the microfinance, like micro savers, I would say micro savers into gold. So if you have the data, can you just tell us what is the percentage of the market, overall gold market in India does this particular customer base constitute?
Oh, 60% of the gold today is being, first of all, you mentioned that this is opposite of micro savers.
Yes.
So I am saying gold is creating micro saving demand. Because today, see, let's look at a lady in a village, let me say, probably village like Pudukkottai. It is close to, it's in Tamil Nadu. Yeah. You can get there from maybe Tanjavur or maybe Adhiyaman Kottai or Ariyadu. Look at a village lady. She today has no savings because she doesn't have a bank account. If she puts money in the bank, it becomes a problem, because if she doesn't maintain balances, then they deduct. There is a minimum balance charge that she has to do. She obviously doesn't understand. She doesn't understand equity shares, doesn't understand preferentials, debentures, mutual fund. She doesn't trust large institutions. She doesn't have access to these institutions. So in fact, because she is able to consume gold, she is becoming a micro saver. So I see a contrasting view to this. I say we are promoting micro savings.
Okay.
So from that perspective, I meant that I don't see that we are again opposite of micro savings.
Okay.
So we are in fact promoting micro savings to these people. Now what happens? Let's say what happens to the, you are also, what is the second part of the question, Mr. Murthy?
I was just asking what is the percentage of this particular customer segment in the overall gold demand in the country?
See, if 60% of this villages, 60% of the gold in the country is consumed in villages, I believe it's very difficult because it's a very new concept. Gold, digital gold is a new concept which has only been there with MMTC and Safegold and Augmont and us for the last 4 to 5 years. So I believe that the 60% which consumes gold today, which is in the rural villages, out of that 15 to 20% will get converted into digital gold. The balance will continue towards traditional routes. There's the traditional route actually shows you designs. Traditional route actually, however, there is a path to the design. There is a path to a piece. We are facilitating that path in a simple way. Your end game can still be the piece of jewelry, maybe the chain or a bangle or a kada or a ring or whatever you want to, whether set for a wedding. What we're telling customer is you don't need to change your shift your goalpost. Your goal is that. However, don't go around saving this way because it is becoming of no use because you are paying for something for which the jeweler is not giving you the credit for that same day. If my customer pays 500 rupees today, I'm buying a portion of he or she is buying a portion of a bar, a 1 kg bar or a 100 gram bar is buying a portion of the bar, which means that if she or he is paying a price on a particular day, that price gets fixed for the customer and customer gets grams of gold or milligrams of gold into their account as there. So as in the jeweler model, it is rupee transaction. In our model, digital gold model, it is grams of gold. As the grams of gold keep accumulating on the 12th month, 24th month, whenever they go, depending on the gold prices, she is able to exit that at that price on that day. And as long as the exit again is the same thing which the traditional jeweler offers, which is you can take jewelry, you can take chain, coin, bars, whatever you feel like. We offer the same, or you can take a loan against it, which means you can continue saving and almost 75 to 80% of that is the RBI related loan, the transaction value. Okay, so you can take that as a loan, or you take a bank transfer, and this is instant. It's a two-hour turnaround time to give it to them instantly. In fact, if it's a cash transfer, it is instant. It happens in seconds.
Wow. Okay.
So when you look at the overall view of this particular thing, that is why I'm saying it's going to be a transformative journey, and transformations and social transformations will obviously takes its own time. We are hoping for more like-minded people to join this revolution so that the market size grows. Because government has tried various things. Government has tried various things earlier in terms of gold monetization. Banks have opened up areas they're asking, but however, all of them are fraught with some disadvantages. And the customer's love for the piece of jewelry is so high, the customer doesn't want to melt it and make it into a lump of gold.
Okay. Yeah.
So it's a very emotional buy, and the more convenience, flexibility, affordability, fungibility, availability, if you make all this easy, the consumer journey becomes easy, and the asset class grows in term because of that. And as Mr. Rao and you have already demonstrated, that the asset class sometimes has outperformed equity indexes also. So it's a great advantage. It's a win-win for everybody. So you have an asset class, plus you have it in affordable, flexible way. You can do what you want, and it retains the flavor of the asset class in terms of emotion and social standing.
Yes.
So then what is remaining? I mean, it's a winning asset class.
Great. Thank you, Jaydeep. Thanks for your real insight into this. So I'll just pose one more question to each of you, and then we can take a Q&A. Rao sir, while traditionally we have known gold as an inflation hedge, recently, despite negative real interest rates, gold has not rallied. In fact, even now we have a negative real interest rate in Europe. On the contrary, investors sell gold whenever the nominal interest rates go up. So is this likely to change in the coming periods, or is this how, or it's going to get, keep on changing as, with each cycle?
See, gold has never borne any interest. It was just an investment vehicle. If you see gold as an investment vehicle, about jewelry demand itself takes more than 50%, and another 40% for investment and 10% for industries. It has been fluctuating like this. Majority has gone for jewelry, not for investment. For investment, very few people, maybe big fund houses like that, they may be doing. Others, like Mr. Jaydeep said, people who buy gold, they don't buy it as an investment so that they can sell it when it goes higher. They buy it to possess that. So interest rate, whether it is interest bearing or not, people are not going to care. Anywhere in the world, people are not going to care about its returns. The main aim is to own that. That is the bulk of demand driver. Maybe the bigger fund houses, they may have a portfolio like 15% of the assets can be in precious metals like that. And now I have not shared certain pictures that is not pictures, like certain items that I use for my own decisions, like whether it will go up or down, or what would be based mainly on statistical studies. Can I share a chart now?
Yes, sir. You can.
Okay. See, this is weekly chart. It's not so far I have been dealing with you in monthly charts, quarterly chart, bigger picture, because I was dealing with the longer term. This is actually the weekly chart, which we may see next week, coming week, like that. This I manually update this chart, so you may not find a date. I do it at the end of the week. You can see a thick line there, green line. Can you see that?
Yes, sir.
That is basically a statistical study, a thick line. You can see I'm running the arrow through that.
Yeah.
It touches that and then shoots up. Similarly, the week prior to this, it touched and then it is rising. And you can see a dotted line there. And also here. This is mainly done for option trading. That is, there is a higher probability for the price to touch this line than this line. So you can sell this option. So this is basically made this study for trading in options. So there is a higher probability for the price to go and touch this line. This is, when I touch this, you can see a data box, a lengthy data box coming down. In that, from the bottom, 1, 2, 3, 4, 5, 6, 7, 8th line, it is VBU. I'll put that again. You count the 8th line from the bottom, there is a VBU, 59,594. So it has higher chance to go to 59,594 than touching 56,727. As on this week, this is the view. So where is the question of interest arising in this? Falling interest, rising interest. People don't care about the interest. They see whether it is going up or down. Speculators will buy. A speculator who is dealing in MCX, this is MCX, he will be buying it. But people who save this, they will, when it dips, they will ask the neighbor, like, will it go down further? Someone who they think that is a knowledgeable person, they will ask them, they will refer to them. Will it go up? They won't worry about interest. They will buy. They will go to the shop and buy something. So it's not one person I'm talking about. It's a bulk of India and China. Both these countries are like this. And you see a similar thing in XAU. Same thing. It is updated till last week because I do it manually once in a week. You can see the thick green line. That is the support line. It has been holding it like this. When it was falling down, the orange line, it was like an umbrella, it was there. It was ensuring that price does not go above that and fall. Similarly here, it has touched and made a U-turn there, which means there is a high chance that the price will not dip below this low, which is 18,092, and start rising toward. Again, I am giving this from the bottom 1, 2, 3, 4, 5, 6, 7, 8 line. You can see VBU 19. It has a higher chance to rise to 1967 than to fall to 1858. It is purely a statistical study based on volatility and log normalizing that and all these kind of things. So the question of interest does not arise in my view. There are some questions I think probably either addressed to Mr. Jaydeep or Mr. Jayaram in the chat box from Mr. Alan Pinto and Pratik Gadia.
Yes.
I would like you to just take a look and.
Yes, sir. There are 3 questions. Okay. So
I'll stop sharing the screen now.
Yes, sir. Yeah.
Yeah.
So this one question from Alan Pinto. So I think before I just wanted to ask one more question to Jaydeep before we move on to the Q&A. So given India is the largest, second largest consumer of gold, and you being part of the core consumer segment, how do you see the trend on demand sustaining given gold is going to be a volatile asset class? Do you see, most of it you have answered. I just wanted your, considering the volatile markets, is it going to affect or it's not going to affect? That just a brief question on that.
Sir, a simple answer is not going to affect.
Okay.
Simply because tell me, when has gold not been volatile?
Right.
It has throughout history, gold has been volatile. Consumer only follow one thing. If it is going up, down, consumers stay away from the market. Moment it shows a slightly rising trend, consumer will go and buy it. This has been my experience for last 30 years, or maybe perhaps with my grand. It has always been like this. If the price is going up and down, they are little skeptical. But it has always been volatile. So what the point is, because the demand is driven by personal choice, demand is driven emotionally, it doesn't matter in this whether there is interest being paid or not, whether it is available or not, whether the prices are going up, because consumers still want it. I'll give you another interesting example. When the floods happened in Kochi, ex gratia was given by the government of India to various families. 25,000, 15,000 ex gratia was given to families. At that point in time, when I was talking to the jeweler network Kochi, their sales had gone up. It's a very, very strange. I mean, half that city and many of the villages, people are using boats to commute from one house to another house. It was a very messy situation with water levels very high. But within that, the moment it receded, people went and bought gold before they bought grocery. The point is, because people understand this is an asset class which is not going to go down in a hurry. This, if any time, see, gold is a scarce, a very, very liquid asset. In the middle of the night, if you take it to somebody and if the gold is pure, you have hard cash for it. It is as fungible as that. It is as exchangeable as that. So it follows a very different. It bothers them. So understand life, and it has shown. Whenever about 50 years back, if you look at the gold prices and see the gold prices today, it is unthinkable that we have gold today at 55,000, 59,000. Mr. Rao saying it go to 63,000, 70,000. It is unthinkable when you used to buy gold. This is not even at that point in time. Ek tola isme, you understand today that this is a gram of gold is worth 5,500 rupees.
Yes.
But yet the demand has not gone down.
Yes. In fact, what I realized was that when I was showing the return on gold compared to stocks, I think if you take the Indian situation, the returns on gold will be far, far higher compared to the stock market, possibly the way it has moved in the local market. Because
especially for my customer, especially for the customer base in the rural, they don't even have a stock market index to go back to and refer.
Yes. Yeah. Okay. Thank you. We'll just take a few questions that have appeared. Mr. Alan Pinto has asked a couple of challenges we see here. Do financial intermediaries see a bigger benefit distributing products like mutual funds, insurance, vis-a-vis gold-linked products? I think, Jaydeep, you can deal with this.
See, I'll tell you why. It's a very good question. It has got to do with two things. One is choosing the right financial intermediary, number one. If you go to the microfinance industry, let's say, if you go to microfinance, their entire base is based on unsecured loans. It's a joint liability group loan where 5 ladies are coming together to give guarantee on each other. They don't give individual loans. It's a joint liability group loan, which means there is a large unsecured loan book which they carry in their portfolio. What happens when they give gold to the same customer? And in one group, they can have 5 ladies. So 5 gold. What happens is a portion of that book starts getting securitized. It's a soft lien, but the microfinance institution, the intermediary, has access to both the data. How much is the loan given? What is the payment history of the customer? And how much is the gold? What happens? The whole communication changes, and they stop building a soft security. Part of their microfinance institution becomes a secure. Part of the microfinance loan portfolio becomes secure. So this is number one, they're interested. Why are they interested? Number two, one is the, like I explained, the soft security. Secondly, they're interested. A consumer, as per the law, can go to 5 different institutions today and take about, as a family, they can take loans from 5 different institutions. That's a cap that they can do as a consumer in the JLG loan group. What happens is when the consumer completes his loan cycle, he no longer goes to another. So you lose the customer because he goes to another place where the interest rate could be better. Maybe the service is better. What happens to this particular intermediary is that they lose a customer. However, if that financial intermediary has also given them gold, the relationship, it stays longer, because customer said, okay, fine, my gold can still continue. Since you cannot give me a loan again, I don't mind taking a loan, but I will continue my relationship. What happens? Because you have access to the consumer and that continues, you can go back to the same consumer with another set of products later. Otherwise, you have a large section of customers becomes inactive. This is the second reason why financial institutions also are interested in doing this. This is the microfinance industry. The third thing is, of course, there is a margin, but gold being a wafer thin margin, I mean, they don't get some massive margins. However, there is an upside to it. Whatever we earn in the difference between what we offer to the customer and how we buy it, because we buy it wholesale, we buy it in kgs and customer gets it in milligrams. The difference between that, we share a portion of that with the intermediary. So there is a financial upside to it. So from all these perspectives, if you are careful about choosing the intermediary, and if it's a microfinance industry, you have the advantage of the secondary, and perhaps that they're not able to, let's say they have insurance, they're not interested in insurance, because those are, while mutual funds, insurance, agri products, solar products, perhaps are easier to sell because gold requires some explanation. The conversion is extremely poor. Gold, the converge, if you go to 10 people, 9 will buy, but the margins are lower. So if you look at the overall financial modeling of it, instead of selling one solar cooker or one solar fan or one insurance in 6 months, they can sell maybe 500 gold plans to the same consumer base with the least amount of effort. So given these advantages, the financial intermediary stays engaged with us and continues to do the business. I hope that answers Mr. Pinto's question.
I think he has another question. Also, considering gold jewelry is the biggest part of gold consumption, will the end jewelers want to redirect that gold demand to financial products in gold?
In fact, they're doing it, because what is happening is the jewelers is another channel for us. What is happening with the jewelers is most jewelers today, and let me give you an example. If you are, let's say, based in Delhi, and you have a single store, I am not talking about the top 5, Joy, Joss, PC Chandra, Tanishq. Those, they have over 150 stores, 130 stores, 120 stores, so they can have pan-India presence. Prior to this, the only company which had pan-India presence was Tanishq, and the second was Gitanjali. If you look at anybody else, they were all regional players. And regulated, 90% is unorganized. Single jeweler sitting in a Delhi, let's say a Rajouri Garden Market, or let's say sitting in Pitampura, wherever in Delhi or in Mumbai, sitting is a very big single jeweler, where a customer comes and buys. And if you take that piece of jewelry and go to another state, the first thing the other jeweler will do is he will say, I want to melt this. Because nobody accepts it on face value saying that, okay, this is, you are saying 22 carat, it is 22 carat. So they will melt it, which means there is a loss of, there's a melting loss as well as a charge. So what happens, the jewelers are slowly understanding that if they want to have a larger base, they need an app-based application, which allows the customer, even if he travels to another outstation location, it allows the customer to continue which means customer loyalty stays intact with the same jeweler, even if it's a single jeweler, because he cannot compete with a PC Chandra, PNG, or any of them, because obviously he cannot carry the inventory. For a successful retail to work in gold, you need to keep a minimum of 75 kilos to 100 kilos of gold. Otherwise, you cannot have a good selection of merchandise. Right. Customers, and imagine these are women customers, and I'm not making any gender biased comment here, but women, when they go to buy, they will want to have choices. It is the sari shopping is the same, jewelry shopping is the same. They'll say, or dikhao, or dikhao, or dikhao. Now, that is not possible for a jeweler unless he has tremendous amount of gold. So digital gold solves that problem. And most importantly, if you look at the unregulated deposit scheme, which was which was a regulation made by Government of India, except banks, NBFCs, any regulated entity, you're not allowed to take deposit. So jewelers have been taking deposit because they are not backing it with gold. The contract law says that if you take money from somebody, you have to give them a service or a product in return. You cannot just take money. Banks can take your money and utilize it. No other business can. Jewelers were taking the money and not backing with gold because jeweler was taking it as a working capital. So what has happened is, because of unregulated deposit scheme, the jewelers also have an embargo. Although in India, it will take a long time before this is, because I told you 90% of the market is disorganized, unorganized. Because jewelers have this embargo today, they will slowly move to a digital gold. Also, let us look at it from a perspective of gold loans. A jeweler has a certain amount of funding availability, maybe 5 crore, 10 crores is own fund. Moment he ties up with a large group, we can give him unlimited balance sheet. His customer base, to retain his customer base, today he's not able to offer because he borrows from the market and gives it to them. If I give him an open line of credit from a bank which is at 8%, 9%, 11%, 12%, the jeweler no jeweler will be able to offer the customer less than 20% today. Even if they do it because it's their fund. Moment I open a line of credit to them from the bank, they are able to retain the customer because obviously 10 times more customers take the loan from them.
Got it, sir. Got it.
So there are various advantages why these people would come. So I think that's...
Yes, sir. Sir, I think the remaining two are also for you. So one is, I have already asked you about this. I mean, there is a difference between the rural customer and supposing there is a savvy customer who has access to all kinds of routes, like a physical gold, sovereign bond, or digital gold or jewelry. Which one would you advise them to go for?
I would still say digital gold, simply because it offers the flexibility.
Okay.
I'm not saying sovereign gold bond is bad. I'm not saying ETF. Sometimes the returns on them are good. At least they give a fixed return. Okay. Sovereign gold bond. However, there is an 8-year lock-in. It's a 5-year exit. At the 5-year, at the exit point, there is an amount to be paid. It allows you 1 gram. It allows you 1 gram. But the point is, in digital gold, you're allowed to go in milligrams. So if you see, I believe, and I have been a consumer person all my life, I believe, leave the choice to the customer. The customer is king. If the customer decides he wants to buy 1 rupee, allow that 1 rupee. Who are we to tell the customer, no, you have to buy it like this, because it works for the government of India, it works for the banks. It doesn't work for the customer. It is like a vote promise. We will do this, we will do that, 100 things we promise. Leave the customer, give the customer make a decision. Customer is savvy enough to understand whether he should put 10,000 or 1 rupee. But give the flexibility. Customer may not be able to do it year on year. So with the advantages, physical gold I've already explained. As far as ETF and sovereign gold bonds are concerned, they are very good investments. However, first and foremost, you need a demat account. Otherwise, you can't do anything, which means you have to be a tech savvy customer, also investment savvy customer, which is not possible in the rural sector. It is not, the availability is not there. And lastly, there is an entry and exit barrier. So if you look at entry exit barrier, then you look at education, you look at accessibility, digital gold becomes the best way to consume gold in your own terms, at your own pace, and however you want it, where you remain the king.
Thank you. That really answers the question. Very straightforward answer. So which platform finally is the best for buying digital gold? And also about
that's not a fair question. I will say smart gold, but honestly speaking, that's left to the consumer's choice.
Okay.
There are not too many available. But however, having said that, MMTC PAMP offers it, Safe Gold offers it, Augment offers it, Piggy offers it, Jar offers it, Smart Gold offers it. I mentioned Smart Gold right in the end, so that I can be fair to the others. However, I think the game here is to have a vision, have a goal, and systematically keep saving without the inherent disadvantages of digital gold and no entry. See, you can go through any route. However, if you look at MMTC doesn't sell through directly, it sells through Paytm or Google Pay. Safe Gold sometimes sells directly. Otherwise, when you go to those platforms, they are not gold platforms. They are platforms for utility bill payments, then transfer of monies. So gold is a by the by. For us, gold is what we live and survive on every day. So obviously, the kind of service you can expect from this, the education you can expect, the transparency, flexibility, customer engagement you can expect will be difficult. It will be different because we survive on gold. Gold is, we are here to create a revolution. We are here to create a change. We are not here to just hang on to something and get some business in the thing. So from that perspective, even if I say it myself, smart gold is the smartest way to survive. That's why we call it smart gold.
Got it, sir. Thank you. So thank you, Sachin, Pratik, and Alan Pinto. So thank you for your questions, and thank you, Jaydeep, for really clarifying them. So Rao sir, finally, I want to just pick your brain on this. You have shown us how to track the long-term trend in gold. Of course, I think most of us are not, mostly we would be short-term traders or maybe a week trader or a month trader. In your experience, which is the most likely workable indicator for short-term trading? You can just give just a few hints because that's where a lot of people.
I would like to. This is a very kind of a tricky question. I can show you some kind of simple systems which you can use for trading in gold. Like you can use that for short-term trades also. You can. I'm just, as I'm talking to you, I'm quickly typing something so that which I can show you as a short-term trading strategy. This is a kind of very crude system, but nevertheless it works. You see, I'll share this chart. Give me a minute. I'm just sharing it. Just a minute. Okay. This is a daily chart. Why I chose investing.com is it's easily available to everyone. It's free of cost. Anyone can use this. you open this chart, just you go to investing.com, type XAU USD, this chart will open. These lines and all will not be there. And in this, you select just two indicators only. You select two, not two, three indicators. You select one indicator called average true range. Average true range is in a day, the price will move this much only. You cannot anticipate more than, sometimes it may happen, but in a day, it will move this much only. For this, my famous example is always 20 over cricket, where people face 120 balls. If you hit every ball to sixth, ultimately you will be scoring 720 runs, which is not possible. If you score 300, that is 1/4 of that, you are good. Similarly, in a day, you can see in this chart, there is a red number. I have enlarged the mouse cursor, red number 20.97. So in a day, it moves $20. So if you score 1/4 of that, that is divide by $5. If you make $5, you are a champion. $3-4, okay, you can earn a living. But what is the certain way? Because trading is not like that. You may lose. SEBI has given it has come out with a finding that 90% of traders only lose money. Out of 10%, 5% just break even. Remaining 5% only make money. SEBI has done a study and they have found that. So how to make that $5 for you? In a day, it moves around. Every day has a different, you see this red number.
No, sir, I'm just sorry to interrupt you. I think Mr. Jaydeep has a flight to catch. He wants to leave. That's right. So Jaydeep, thank you very much for joining us. I'm sorry we overshot the time.
No problem.
Thank you very much
that is why I was hesitant.
It's okay.
But Mr. Rao, thank you so much for your insights, and I will take your.
Yes, exactly. That is why I was very hesitant when you asked me. I looked at the clock; it was already 6. Then I thought it will take at least 10 minutes.
Okay.
So I thought I would better.
So thank you, everybody. I am logging off, and thank you for first of all to Almas for the opportunity.
Sorry,
and thank you for introducing me to Mr. Rao. It's great to have your insight, and always a pleasure to talk to participants on gold and digital gold. And I remain very passionate about this. So thank you, everybody. Thanks for the opportunity. Hope to reconnect with you soon again.
It was our pleasure.
Please invest in digital gold.
Yes, sir. Okay, thank you very much for sparing your time and sharing your knowledge. Thank you. Thank you.
Bye.
Thank you, sir.
Thank you, Mr. Jaydeep.
Kushi, we have the time, or we can have it sharing in another session also for this.
So we can have